Rapon with Seattle. Good morning. This is Jim Rapon with Seattle Real Estate Chat, and I'm joined here with Rhonda Porter. Rhonda, would you introduce yourself?
Sure, thanks, Jim. I'm Rhonda Porter, and I'm a licensed loan officer with Mortgage Master Service Corporation. And I'm author of the blog, The Mortgage Porter.
Okay, Rhonda, I think your sound is a little scratchy, so maybe move your mic down or try to make sure it's not scratching against anything. It seems to, but anyway, hopefully it's okay.
Okay.
So anyway, oh, that's better. So today we're at the end of the year, so we were going to do a year-end roundup of talking about some of the highlights of 2015 and more importantly, predictions about where the market may be going here in 2016. So we'll just take some wild stabs at what we think may be going on, and then you can hold us accountable at the end of next year and see if we were right or wrong. It is a bit of a guessing game at best, actually, but there are certain factors that kind of lead us towards certain assumptions about what the market's where it's gonna go and how it's gonna be. So with that said, why don't we start out with you, Rhonda, and you can talk a little bit about interest rates and maybe even start off with these new FHA conforming rates that just came out.
Well, the loan limits have been announced just this past week for FHA loan limits and for conforming loan limits on conventional loans. And they, in the Seattle-King County area, actually the Tri-County area, so including Pierce County, and Snohomish County, have gone up. And they're not as high as they once were at their highest levels, but they are, for 2016, for single-family dwelling, a loan limit for a single-family dwelling for both FHA and conforming mortgages will be $540,500. So it's an increase of $23,000. So it helps for those that would, especially in our markets, which are higher price, is how we were able to have a higher loan limit. Helps avoid having to go into a jumbo loan, which may have typically has tougher underwriting requirements and requires more of a down payment.
Yeah, no, I had heard that there were only something like 5 or 6 counties across the country that had seen increases like this. Most of them had been actually because they were still kind of trying to get from being underwater. FHA still didn't want to try to raise those limits and artificially inflate those markets. Did you hear that, or do you have any statistics on that?
It was just a few counties that received the higher loan limits or saw an increase. And so it's typically based off of home values too. So in the area.
Yeah.
So
yeah, that matches with my experience too with because King County, and particularly the greater Seattle area, has had such a steady and consistent rise over the last couple of years. It makes sense that this would have been one of those key areas in the United States that that they did that for. So that's going to be really important for, especially for condos, but on houses too, especially if you get right outside of the downtown corridor. If you're in Edmonds or Shoreline or Everett or down further south in Burien or Renton or Federal Way, that buys you a pretty darn good house.
Oh yeah, yeah. No, it's great, and with FHA, it's a still a minimum down program, and so you can get a nice house without having to put a lot down. And conforming high balance is reducing their requirements too, as far as for how much is required for down payment.
And they still have that slightly higher private mortgage insurance factor, right, than they do on conventionals.
Right. FHA.
Yes.
Yes. Yeah. But oftentimes, I mean, you have to really compare both scenarios because oftentimes the rate for FHA is lower, the interest rate. So it's worth checking it all out to see which one makes the best sense for someone. VA loan limits, I checked again this morning just prior to us going live, and they have not been updated yet for 2016.
I suspect that's more a factor of the internal bureaucracies of government than the fact that they won't. They tend to follow right in line with FHAs, right?
Not always. I mean, they have FHA is actually following conforming on this one. The conforming loan limits were announced first, and VA has been actually following conforming, or that's what they have on their website, is that they will follow what conforming does. But the last announcement though for that was for 2015, so we're still waiting for the official word. So I hope it's increased as well for VA.
Well, good. So tell me, what are your thoughts here about where do you think things are going to be going for interest rates?
You know, Jim, I think they're going to trend higher. And I know, like, sometimes I feel like a broken record because we've been saying this for a long time, and then rates have stayed low for a really long time. But tomorrow we're going to hear from the Fed as to what they're going to do with the Fed funds rate. And it's highly anticipated that they're going to raise rates by a quarter point, and mortgage rates have been trending higher as we draw near to this date tomorrow. So my expectation is that we'll see rates to continue to trend higher. I don't think it's going to be in leaps and bounds, but to see rates, you know, around the 5% range, I don't think should be a surprise.
Yeah, and that's sort of what I thought too. I actually was thinking it might not be quite that high. I was thinking we might see a quarter to a half of a percent bump, and then maybe towards the middle of the year, another quarter or half. It is an election year after all, so they don't want to put too strong of brakes on the economy, is my guess. But they want to make sure that as they do these things, they don't see things in the market slide. You don't want to see the stock market slide off. You don't want to see housing starts drop off. And so if other factors are kind of coming in there, obviously that's going to affect their decisions.
Well, and I would say 5% by the end of 2016, but maybe I should preface that a little more. But I do think, yeah, we're going to see higher rates. They've been just so low for so long that they have to go up.
Yeah. Well, and if I was a betting man, I'd say somewhere in the middle of that, but it could be. And historically, 5 to 6% is not bad. The only problem is that history has been a while ago. So yeah, that's not going to mean anything to millennials who have, for all of their adult life, seen 3 to 4% interest. I mean, they've only been in the market 5, 6, 7 years, and during that time, they saw a collapse and low 0 to 0% Fed rates and 3 to 4% in interest rates for homes. So when they see 5 or 6, they're probably going to go, ugh, the world's ending. But as we both know, it could be much, much worse, and that's really not a bad rate.
Right. So what predictions are you seeing for 2016, Jim?
Well, like I said, on the interest rate side, I'd probably go somewhere in the middle of where you were in terms of amount of increase, but I do see an increase, and I expect we'll see one this tomorrow, actually, maybe the first, and then, but I think it'd be very, very modest, and I think that the Fed's going to dip their toe in the idea and then slowly increase it and go maybe 1% to 1.5% total by the end of 2016. Housing market, I think in the Seattle area, we're going to be strong in sales, but low in appreciation. I think that we've had some real big jumps over the last 2 or 3 years, and in the 10 to 12% range in some cases, and that's not sustainable. But on the other hand, we have a lot of growth rate in employment and in people moving in, and rising incomes because of a number of factors. One of them being just last night, the Seattle City Council voted to allow Uber drivers to unionize. So probably no more cheap Uber rides by the end of next year or whatever. But that the 15-hour minimum, all of those things are going to be kind of bringing the bottom up on the income factor. And then on the top end, that's growing gangbusters with all of the hires for Amazon and Expedia moving into Seattle, and Facebook moving into their new buildings soon with more hires, and a number of high-tech companies, and particularly the biotech industry and medical industry is growing very quickly in this region. So all of that signifies a strong market, even if you don't have a big appreciating market. I will say that inventory has been extremely, extremely tight. It's been tight for several years, but it's accelerated that by a factor of double, pretty much, in this last quarter or 2 quarters of 2015. So I expect that will change. And in fact, I think I've got some other people predicting the same thing. Let me pull up. This is an article that I saw on Realty Track here the other day, and it's they're a national reporting agency that does a lot of statistics, and they're talking about how a lot of places are kind of peaking around the country. But I noticed that the Matthew Gardner here had a little bit of notice on here. I don't know if you know Matthew. He's really been a real estate analyst in the Seattle area for a number of years. He now works directly for Windermere, but he states in here that he anticipates that sellers or baby boomers are going to start letting go of their properties. They've been holding on to them longer than they thought. The larger 3, 4, 5-bedroom homes where they grew their kids grew up in and all of that. But he's expecting that in this coming year, you're going to see more of those properties become available on the market, and that's going to loosen up the inventory a little bit. So I think that's probably a pretty good prediction, that we have an overabundance of people living in 1, 2 people living in 3,000 square foot homes, and that is historically been something you'll see a change on at some point, a generational change, and it's just lasted a little longer than it has in the past for whatever reasons, and probably a lot of it to do with the fact that a lot of folks had gotten underwater back in 2006, 7, 8, and just got out of it, and they are still kind of trying to get their nest eggs going again. Well, now they're at a position where they've actually got enough equity where they could liquidate those properties and then move forward with their retirement plans. I'll bet probably a little bit scaled back.
Mhm.
So everybody took a haircut this last recession, and baby boomers are no exception to that. But I think that you'll see more people putting homes back on the market than you did last year. So I think that'll make a big difference. But downtown, the condo market, I think, is going to be a little different. We have a huge amount of growth downtown, and everybody sees it. Drive by downtown, packed full of cranes, constructions everywhere. Many of them are high rises. So I was talking with someone the other day about how I did a little triangulation with the mapping of from Denny down by the Westin to I-5 up to Lake Union and across to the Space Needle and then back down to the Westin. In that corridor, I think I found something like 56 construction projects.
Wow.
And of those, 17 were towers over 40 stories.
Mhm.
So these are projects that are either the dirt's been broken, they're in construction already, or they've been permitted to do so, and they plan on starting construction in 2016 or 2017. So that Denny corridor is going to be hugely different, particularly around where the Seattle Times and the Whole Foods is, that little area.
Mhm.
There's 8 40-story buildings going right in that 5-block radius there. So, and 40 stories is pretty big, particularly for that area. It's not like it's the center of the financial district or anything. So, and here's the interesting thing about it. They're mostly office buildings, but of the multifamily structures going in, about 90% are apartments, not condos. So we're
Mhm.
talking a very strong market for apartment growth and a very weak one for condominium new construction, which means the condominium market will continue to be tight and will continue to probably have a very strong pricing and maybe even more appreciation than homes. Normally, traditionally, I should say, we've seen condominiums kind of follow housing and appreciation. If you had a 7% appreciation in homes, maybe you'd have a 4 or 5% appreciation in condos. That seems to have been mostly the way, again, things that went traditionally. I kind of suspect it might be reversed of that this next year or two, as the tight condominium market continues to tighten. And the reasons behind it are numerous, but the basic one, it's about money. These developers have found that price per square foot, selling multifamily units to large investment portfolios first of all, it's a lot less risky. And second of all, they're getting more money than they would if they had to go through the cost of condominium, making them into condos, I should say, and then selling them off as individual units. It's just not that profitable. And when it is profitable, it's usually in the luxury end. That's the other thing I wanted to point out. Of the units that we see coming on the market, most of them are in the mid to higher level price range. So between 700,000, 800,000 and 2 million. That's sort of the sweet spot for the developers. So you're going to see even more constrained inventory in that lower, if there are $300,000 condos in downtown. Anyway, from there to that 700 range or 600 range, that's kind of that now the lower to mid range pricing. But the inventory of that is almost non-existent. Is non-existent for new construction, except for maybe the Luma on Capitol Hill, but that's not even really in the downtown section. But the resale market will be very tight. So yeah, that's kind of my predictions. And I think what's important to also keep in mind that the risk factors, we don't really have any idea about what kinds of factors that could affect us that we don't have control of. And unfortunately, with these terrorist attacks in San Bernardino, of course, the one in Paris, everybody's on edge about that. And Seattle is just as vulnerable as any other city. So if some sort of attack like that happened nationally, but specifically locally, that could devastate any market, and ours included. And then there's the natural disasters. While we are usually completely off the grid with all these hurricanes and snowstorms and floods and all that, we are in the high risk category for earthquakes. And I like to kind of always bring people back to that, because it's sort of the not the silent killer, but it's I think it's the one that because people can't really predict it, and it happens so fast. I've been through these things, and it really can totally destroy your life, as well as destroy an area. And we are in a very, very active zone for that, and quite frankly do. So yeah, those are things we just can't control. But I'm pretty optimistic about 2016. I've been talking about brokers around the country who are more nervous, but I think if agents who are active are going to do well. I think buyers and sellers are going to do a whole lot. I think we'll probably do a lot more transactions in 2016 than 2015, quite frankly. And a lot of real estate is going to be exchanging hands. So there's opportunities out there for people buying or selling.
Yeah, it'll be great to have more homes on the market, more inventory for buyers. Because I know, I've been working with some buyers that, they've literally been waiting a year or more, just for the right home for them. So
right.
So it sounds like that's still going to continue to a point, but
you're right. People need some sort of choices. They don't want to say, pick A or B, or oops, B's gone, pick A. And people, maybe if they're in a forced situation of relocation, they have a family, but even then they may go to the rental market, as tight and as expensive as that is, just because there at least is some choices, and they can wait until they find something. But in the last 2 years, people who've done that have kind of lost out, because prices have gone up 10–50% since they started looking, and they're going to then have to lower their expectation even more, unless their income's been going that fast, increasing that quickly. I don't expect that to be the case, though, so much in 2016.
Yeah, good news.
Yeah. So that about wraps it up for us. Want to tell everybody happy holidays, Merry Christmas, Hanukkah, Kwanzaa, whatever the ones you celebrate. It's a festive time of year and a blessed time of year. We're all thankful. And, you kind of look back at a year and you go, wow, this has been a really, it's been nice to be going around the planet one more time. We're thankful for that. So anyway, we're looking forward to doing a whole nother year next year, starting in mid-January, and we're going to have some guests, more guests, and try to include more people, guest speakers. And if you've got any suggestions, please send them to us, email them to us, or you can hashtag hashtag Seattle RE chat, and we'll see those as well. Ron, any last thoughts from you before we wrap this one up?
Oh, I'll just say, yeah, Merry Christmas, Happy Holidays, and Happy New Year.
Yeah, right. Okay, folks, thanks so much for joining us. We'll send out a notice when we're doing one early next year, and we hope to see you then.
Yes.
Bye now. Have a great end of year.
Take care. Yes. Thanks,
Bye.
Jim. Bye-bye.